All right. Well, thanks again for joining us tonight. We've got a jam-packed presentation for you. So when I lose attention from the camera here at Fairhaven Global Headquarters, where we're shooting this from, I've got both Lori and Gina helping me here in the conference room. So they're both camera shy, but they're off to my left, helping with the slides, also monitoring the chat box. So we're going to use the chat box as a way to lob out whatever questions or comments people might have. Let's keep it clean. Let's keep it professional. But we're going to also try and handle questions as we're moving along through the material. So some of the topics that we're going to be covering, we're going to dive right into some topics that are just near and dear to all of our hearts, and that's politics. So we're kicking it off. We're kicking it off strongly. We are also going to get into the little update on the pandemic, how the economy is doing, talking about inflation, which has reared its ugly head for the first time in a long time. Also talk a little bit about the latest stock market volatility. And we've got a few other topics to cover as well. But again, be active in the chat box about whatever topics we should make sure that we're covering. So politics. Let's set the stage appropriately here. Tonight's presentation is about the economy. It's about investments, and it's about your financial plan. So the government and our wonderful government leaders certainly have impact on a far more broad set of issues, all of which are important. But tonight, for this particular slide, and especially, we are focused on what politicians do, what sort of influence that they have in the investment markets. And unfortunately, it's not all that headline grabbing. As you're looking at the chart in front of you, going back to 1926. And capturing the Trump era. We have not had the chance to update this for the Biden start. But what you're seeing is the influence, or the performance rather, of the U.S. stock market during various presidential regimes. So blue being Democrat and red being Republican. And the long-term trend is just crystal clear, and that is the investment markets just have this frankly wonderful ability to look through all the political noise, to digest whatever policies it is particular administrations might be interested in, and just persistently march higher. So the numbers themselves, if you go back and look at average annual returns under Democratic regimes, the average presidential regimes, the average annual return for the market is about 8.6%. Under Republicans, it's 8.4. It's just, there just is not a meaningful difference between one administration to the other. So once again, this is purely about the investment markets, but we'd encourage you, as headlines tend to get us all worked up, as far as your financial plan goes, who's sitting in the White House just doesn't matter. The results are shockingly consistent no matter who's in charge. It's also important, before we leave this slide, to think about the time frame of these various bars. So we're talking about presidential regimes. So I think this is going to cover some single-term instances. So 4 years, and then a 12-year period with the Reagan-Bush years. So these are not week to week. This is not week-to-week performance. This is over some period of years. So we can't avoid what's going on with the pandemic. It's a persistent part of our life. So I think an important update on the statistics there. So as we're moving to the next slide on the pandemic, what you're seeing on the left-hand side of the screen is case counts. On the lower right-hand side of the screen is mortality from COVID. Now, I should confess, I flunked biology in college. I had to take it in summer school. I did just fine in economics and investments, but medical interpretations, that's not something anybody should be listening to me about. So I'm just looking at these from a numerical perspective. And so if you look at that chart on the left-hand side, we are the blue line, again, the case count, we are at all-time highs with the Omicron variant in case count. And how I'm choosing to interpret this information in an encouraging way is, if you took that case count that we're experiencing right now and applied it to the reactions that we had throughout our lives a year and a half ago, nobody would be in restaurants, nobody would be out on the roads. We'd be seeing videos of the hospital ships steaming into the New York harbors. Worst of all, golf would be banned as it was here in Illinois, and none of those things are happening. So that suggests to me that as we're learning more about COVID, as our scientific knowledge is developing, as solutions have emerged in both the vaccines and various therapeutics, we're learning how to deal with this and get our lives back to normal, which again I think is a very encouraging sign. So that's leading me to conclude that we're closer to being towards the end of the pandemic than we are the beginning, which is not to say that I think we're going to have a life without COVID. My view is that this is going to be here for quite a while, and be perhaps a permanent part of our lives, but that we're slowly learning to deal with it. So the economy, as we're thinking about how again, back to the numbers, the economy reflects, I think, something very similar. So what you're seeing on the left-hand side of the screen there is economic growth, which over longer periods of time has trended around that 2% line. The blips that you're seeing both on the 08-09 period, and then that dramatic blip on the right-hand side of the screen, those are recessionary periods. And you're seeing, especially in the recent recession, just the dramatic rebound. So just recently, the latest economic information is that the economy is growing at something close to a 7% rate. So it sure seems like, again, from an economic perspective, that we're learning to deal with the challenges that we have. So the economy and government spending gets talked about a lot in the same breath. So the chart on the right-hand side really breaks down what the economy is really made up of, and 70% of the economy is due to all of us. So the activities that individuals make in their own spending pattern. So I think it's also important to, as you dig deeper into the economy and where we stand right now, because the consumer is such a large part of the economy, to really get a flavor for where does the consumer stand. So on a variety of metrics, this is going to be a summary of kind of a profile of the overall consumer. So I think it's also important, as we're looking at these numbers, this is at a very high level. It does not get down to individual consumers, which certainly there are pockets of our country or the world that have disproportionately felt the pain of COVID. This slide does not get into that, even though it is quite real. But at a very high level, the upper right-hand chart is reflecting a debt service ratio calculation. So that's a measure of how much income, how much of your household income goes to service debt. It's at a 40-year low, which is a fantastic place for the consumer to be. So we have had a new experience recently. So inflation has reared its ugly head, which has been gone from our economic experience for quite a long time. So from a pure economic definition, inflation is a loss of purchasing power. In English, stuff costs more. And I don't know that I need to share that with anybody who's put any gas in their car, who's been grocery shopping, anybody out there that's buying and selling used cars at profits, which is just a ridiculously abnormal thing to actually profit from selling a used car. That doesn't need to be explained. So here we've got a view of the long-term trend line of inflation, which is going to be a little above 3%. The last number that we saw was closer to 7, and so that's very real. That's got as far as your financial planning and investment strategy goes, that's got some considerations to make as far as actions that you might take in your plan. And one of those is related to the Fed, because the primary tool that the government has in beating back inflation is the Federal Reserve. And so Chairman Powell was speaking earlier this week, talking about what the Fed might do as it relates to interest rates. So and what he communicated quite clearly is the plan for the Federal Reserve to begin increasing interest rates at a slightly measured pace, but dependent completely on the data. So what that means is we're likely going to be looking at later in the year, and what Chairman Powell talked about is in March, the Fed starting to raise interest rates. So that's got ramifications for, again, as far as the investment portfolio goes, in particular, the fixed income side of the portfolio.
Mark, how long do you think inflation will last?
So that's a great question. 3 or 4 months ago, the Fed was out talking about, most talking heads on Wall Street were talking about it being transitory, which meant that it was going to go away at some point soon. I looked at some information actually back in the 1970s when we went through a very high period of inflation, and they use a lot of the similar language, like it's just going to go away. That tone has changed, and my guess is that inflation is going to be with us for a little bit of time. And so explaining why it is that I think that inflation just in general is, so Brian Westbury is a great economist that we love to follow. He's got a super example, I think, of explaining how inflation works. So his example would be if you've got 10 apples and a group of people that have $10, the average cost of an apple is going to be $1. When you increase the money supply, which is what it is that we've done, you might now have $14 chasing those 10 apples, driving prices up. What we did in the pandemic in terms of shutting down the economy also affected the number of apples getting to the shelves. And again, I probably don't need to elaborate on that for any of us that have been in the grocery store. There's less things on shelves, and so reducing the amount of products that might be available while increasing the amount of money chasing those products is just going to naturally have an effect to drive prices higher. And so our economy being as large as it is, it's hard for me to imagine that as we're emerging from the pandemic and returning to a relatively normal time, that inflation goes away quickly. So I would expect inflation to last perhaps at these levels, or start to slowly subside through the balance of the year and into next year. But that's a guess, and that is going to depend on how more factors evolve through the course of the year.
Next question is, what's driving inflation, which you pretty much touched on that, but will the interest rate adjustments curb that? Yeah, so the tools that the Fed has two mandates. One is full employment, which we have right now. So again, back to the strength of the economy, we are at full employment by any measure. The other is price stability, and so that's a fancy way to talk about inflation. So they are keenly focused on getting inflation under control and reducing that. They've got their primary tool in dealing with that is raising interest rates. So again, they've been quite clear that we're going to be looking at a
higher interest rate environment to try and beat back down inflation. We'd fully expect, again, back in March, or this coming March rather, to see Fed rate increases. And then Chairman Powell was quite clear about remaining flexible and seeing and responding to the data as they see it. So I think I believe the Fed's going to be careful in how they move on increasing interest rates to make sure that they don't put too much downward pressure on the economy, while they kind of strike a balance in having interest rates at a level that still promote economic growth, but also are helping combat inflation. So a combination of rising interest rates plus our supply chain issues getting fixed should contribute to inflation dropping. So what does that mean for your portfolio? So let's start with fixed income. So on this chart, we've got a breakdown of performance from last year of various elements of the fixed income market. And so frequently we'll hear media people talk about rising rates or death for the bond market. And so you don't want to own bonds. Those are very broad sweeping statements. The bond market is made up of all sorts of different types of bonds. Some are more sensitive to interest rate moves, and others less so. So in general, in the bond market, risk is made up of two big buckets. Interest rate risk, so those bonds that are largely sensitive to interest rates, and then credit risk. So credit risk is the risk that the issuer of a bond is going to go bankrupt or not fulfill their obligations to make their bond payments. A very good example of bonds that are disproportionately sensitive to interest rate risk are going to be government bonds. So in theory, the U.S. government there is no credit risk, that the U.S. government will always honor its obligations, and so that leaves interest rate risk. And you saw that in action. So the middle column of that chart on the left-hand side, the 2021 year-to-date return, as you scan down that, you're going to see negative numbers for government bonds at the top of the chart, with the exception of TIPS, which stands for Treasury Inflation Protected Securities. You're going to come back to that one in a minute. But you're seeing what we just discussed in action. Government bonds, their performance largely impacted by moves in interest rates, as the expectation for rising rates has really run through the market. That's made investing in government bonds very difficult. But as you keep going down that column, you're gonna come across a number of other types of bonds. So there's convertible bonds, there's high yield bonds, there's municipal bonds, there's floating rate bonds down at the bottom. Preferreds are another area of the bond market, and you're going to see positive numbers in some of those areas. Now, what that means is some of those areas of the bond market are less sensitive to interest rate moves, and so there's more credit risk there. So one of the takeaways here on this slide again is that not all fixed income is made the same, and abandoning entirely a fixed income portfolio out of fear of rising rates is probably too strong of a reaction. That there still remains opportunity. So let's go back to TIPS. So Treasury Inflation Protected Securities, as the name implies, their performance is linked to increases in inflation, and as you see the performance from last year, they did well as inflation expectations rose. So a reasonable question might be, okay, well, if inflation is here to stay, shouldn't I just be backing up the truck to TIPS? And we've got some challenges with that line of thinking. If we are correct in that inflation will eventually subside and slowly subside over the year into next year. TIPS might actually underperform in that environment because inflation is starting to move down. The other challenge with TIPS is if you look at them from a long-term perspective, so like a 10-year average annual return for TIPS, it's something in the 2 to 3% zone. So it's a tool in the investment toolbox that really only performs under very specific circumstances. We would prefer, and that's true, I'd say generally, as we're putting together portfolios for clients, we would prefer elements of the portfolio to be able to have a little bit more flexibility and to be able to perform well in a wider variety of environments. And so again, back to 2021, there's a number of other areas of the fixed income market that did just fine in a rising inflationary environment with an expectation for rising rates. And we would prefer to have exposure to those types of assets rather than an asset that really just performs well under very specific circumstances. We're going to related to this as far as the inflation discussion goes and what asset classes might make sense. Another one that gets talked about a lot is commodities. We're going to be covering that as well.
Mark, I have another question coming in here about inflation. It says, how much of the current inflation is the thinly veiled attempt of businesses to make up for all their losses over the last 2 years in the next few months?
The thinly veiled attempt. Okay, I think that question is getting at businesses. See if I understand that. Businesses taking advantage of supposed inflation to raise prices to increase profitability.
I would agree.
Yeah, there's probably some bad actors out there. I would say that maybe are looking at this as opportunity. I'd say across the board though, as we're going through earnings seasons right now, and we're hearing reports from a wide variety of companies talking about the performance of their various businesses. Across businesses, company management are talking about the challenges of supply chain and prices going up. I was visiting with a friend of mine last night who's in the higher education world, and so colleges and universities are struggling with this. So I would concede that there probably are some people out there that are taking advantage of these circumstances. I don't know that makes inflation any less real.
Another question is, does it surprise you to see 7%? Because it seems like everything we touch is much higher than that. And the manufacturing business seems more like double that.
Yeah, that's right. So if you dig into the various elements of the economy, there's plenty of examples that are higher than that. But that the headline number of that 7% is a broad-based average. So just like averages, there's going to be some that are a little bit lower than that, and others that are higher. Yeah. So let's talk about volatility. That's another one that we just can't stock market volatility that we certainly cannot get away from this week in particular. And so it can be, well, we had one day where we were down, the Dow was down 1,000 points and then rallied right back. So 2,000 points of market move in one day, which can be breathtaking. And it's easy to forget after we go through periods of volatility, and then we rebound from that, just how scary it can be in the moment. So the chart that you've got in front of you there is going back to 1980. Those are annual returns for the S&P 500. So the blue, the numbers up along the top is the actual return for that particular calendar year. The numbers along the bottom are how much the market was down, the maximum amount the market was down during that year. And it's remarkably consistent just as you're moving across the the chart, in order to get an average return in the S&P 500, which might have been around 10 or 11% for this period, you have to be willing to stomach and stick with some pretty big moves during the course of the year. The average for this period is something like 13 to 14%, which I'm sorry to say this out loud, but we haven't hit that point yet in the current market. So there could very well be more downside waiting for us. But what we're going through right now, as unpleasant as it is quite normal. It's quite normal. So we're talking a lot about the S&P 500. There are other investment markets out there. So this is a chart that looks at the relative performance of the US market versus the international markets. So the purple is outperformance of international markets. The gray is outperformance of US markets. So we're in a period right now of, I think we're starting year 14 of outperformance by the US markets. And the chart here again seems just persistent in that the pendulum does tend to swing from one to the next, and it's easy to think that you actually got a name for it in behavioral finance, which examines the behavior of all of us investors and how, in some ways, we're wired not to be great investors. And so one of the biases that we all tend to have is recency bias. And what that is the idea that what's going on now, we just think will continue. So one example that we might all be guilty of is, as you're sitting in traffic, you're sitting in a traffic lane, watching the lane next to you as cars go by, and you start to think that, I'm clearly in the slow lane. So then I change lanes to get into the fast lane. And what happens most of the time? That lane comes to a screeching halt, and then the cars that you were behind in the lane next to you go whizzing by you as traffic changes its pattern. That's an example of recency bias in action in our daily lives. So it would be natural, given the last 13 or 14 years, for investment portfolios to be overweighted to international, both because of their outperformance, but then also because people just get frustrated with the underperformance of their international investments, and so move over into the S&P 500 lane. That long term is going to be a mistake. And so this is not to say that it's time to just abandon the S&P 500 and back up the truck to international investments, but certainly reviewing your exposure to international investments would be a very worthwhile thing to do. Right now, they offer a higher dividend yield than most of the U.S.-based investments. They're trading at lower valuations, so cheaper than the U.S. markets. And it's a limited sample size, but over the last 3 weeks, the difficulty that the U.S. markets have had, the international markets have had less difficulty. So in some cases, half the downturn of the U.S. markets. So again, not time to back up the truck to the international markets, but certainly worth making sure that you've got global exposure. So one of my favorite charts. It's called the Quilt Chart. So the years are along the upper axis, so going back to 2007, and then returns of various asset classes in different colors going down the chart. The white box with the line going through it, that's a hypothetical diversified portfolio of the various asset classes, and what you're seeing is a well-diversified portfolio is never at the bottom, it's never at the top. It's smoothed out the investment experience to try and take out or reduce the roller coaster that some of these asset classes can be. So I mentioned commodities. Commodities is another asset class that gets referenced in fighting inflation. Commodity performance, that's going to be the green box. So back in 2007, it's up near the top. And if you go year by year, commodity investments as an asset class just have this persistence of being at the bottom. And over actually long periods of time, their average annual return is negative. So there again, it's a conclusion for me that the commodities are a very specialized investment that really only perform well under certain circumstances. And if a person's going to have exposure to commodities for a long period of time in their portfolio, they're going to have to stomach some pretty disappointing returns. So my conclusion there, as far as commodities go, as an investment, would be similar to my conclusion on tips. We'd rather populate the portfolio with investments that are able to perform in a variety of different market conditions, not be so narrow.
Mark, is there any asset classes you'd stay away from this year?
Yeah, so we've talked a little bit about a few. So on the fixed income side, those asset classes that tend to be more sensitive to interest rates. So that's going to be something like government bonds. On the equity side, I don't know about staying away from, but again, it would make some sense to look at some of those investments or asset classes that have really treated you well in your portfolio recently, and look for opportunity in some asset classes that maybe you've been a little bit disappointed in. So it's another way to talk about the idea of making sure you've got the right balance of both U.S. and international investments.
Okay, I know it's discouraged to try to time the market, but if you take RMDs for donations, should you do it now or should you wait later in the year?
Yeah, so if we're talking about RMDs have got to get done by the end of the year. So that means they've got a time horizon at the moment that's about 11 months away. We would not be advocating anything from an investment perspective that had an 11-month time horizon. That's clearly timing from our perspective. So I would not be inclined to spend too much time thinking about, is now the right time to take your RMD, or should I wait? If you don't need the money right now, if you're using your RMD for month-to-month living expenses and the checking account has got enough in it, I'd be inclined to wait to see if we get some sort of market bounce later in the year. But if you need the cash, you need the cash. So then I'd be inclined to go ahead and take it.
Does a midterm election year present any unique challenges?
Right, we can't get away from politics. So yeah, who knows what's gonna happen with politics. If I was advising, if the president called to ask my opinion, I would encourage him to try and abandon this massive Build Back Better plan and really try and get something done on a bipartisan basis. It's my view that that's primarily why he was elected. That people felt like they're sick and tired of the division in Washington, and that he would be able to get something done on a bipartisan basis. And so I would encourage him to think about doing that, especially leading up to the midterm elections. I think that would result in good things for the Democrats. Now, the White House has not called our office unless they have, and Denise here in our office refused to put him through, which for anybody that knows Denise, I'm not making stories up, that's entirely possible. But either way, that's what I would encourage our government leaders to think about. From an investment perspective, midterm election years from a glide path tend to be more, the stock markets tend to be more volatile leading up to the election. So I would expect that to continue. They also then tend to perform quite well post-elections. That might argue for a stronger fourth quarter. You got to be careful about that though. As soon as you think you spotted a pattern in the investment markets, they have this just evil way of showing you just how wrong you are when you try to play those patterns.
And before we go, is this your real background?
Yes, it is. Yes, it is. So for those that can see in the background, yeah, those are bowling shoes hanging on our wall. I'm sitting at our conference table, which is an old bowling alley, out of a bowling alley in Southern Illinois. So we've done a very intentional job of trying to create a unique environment here in the office. So you never hear this word in an investment discussion. I guarantee, for those of you that have not visited the office, if you come by and take a look at the office, it will be a different experience than you have with any other financial firm. So I guarantee that. So yeah, this is the actual background, not some CGI thing. Is that what we're seeing?
I don't have any other questions, so throw it out there.
Yeah,
does anyone
sure.
have anything else?
I think it was in the invitation, the mention of crypto. So let's go ahead and just address that as well. I don't understand crypto, so I don't get it at all. I probably confess I'm not all that interested in getting it. So I guess I'm stuck in my ways on that one. I don't understand the what they use words like store of value. Well, it's down like 40% or something like that for the year. So that doesn't sound like much of a store of value. I think I hear things about, well, part of the advantage of crypto is that it's unhackable. That phrase immediately makes me think of other times in human history when hubris has come out. So ideas about ships being unsinkable, about the new economy, revenue doesn't matter. It's about how many website clicks that your website gets. The idea that real estate values always go up. There's never a case when real estate goes down. I'd say history is littered with instances when human hubris has ended poorly. And that would be my view on crypto. That being said, within our portfolios, I know that there are underlying investments, underlying companies that are addressing the role of crypto and trying to find ways to take advantage of that. I'm thinking about names like Visa, MasterCard, PayPal, payment processors that are going to be underlying investments in our portfolio. I'm perfectly happy to defer to them to figure out what the right role is, but I don't know that you'd ever see, from me anyway, an explicit allocation to crypto.
We have a question coming in here asking if you're a fiduciary.
Yeah, great question. So we are. So Fairhaven is a fiduciary. So what that means for those that aren't familiar with that term is that we are obligated to act in the best interest of our clients. Not all financial advisors have that obligation. So that's an important, which I should say doesn't necessarily make them awful people, but I guess related to a previous question, those people out there that are intentionally taking advantage of inflation to raise prices, those people aren't fiduciaries. But that's a great question to ask of any financial advisor so that you understand what their obligations are. But yes, we are fiduciaries.
If you were convinced that their higher levels of inflation were on its way and staying for the next year, would it change your thoughts on portfolio allocation?
You know, I don't know that it would. Because again, fundamentally how we think about portfolio construction is back to that idea of having assets that we think will have opportunity to perform in a variety of environments. Another lesson that I've learned in my 20+ years of being in this business, when you pound the table in the investment market about being just convinced that something is going to play out in a particular way, the investment markets have a way of bringing you some humble pie. So no, I don't know that I would. We like constructing portfolios that have got flexibility built into them. So some takeaways for tonight. As far as politics go, again, through the lens of your financial plan, try and look through it. The investment markets have this wonderfully refreshing ability to just look beyond the noise of politics and just keep doing their thing. Both the economy and who makes up the economy is disproportionately the consumer in general is at a very good place. Inflation's probably going to be with us for some time, but we would expect it to begin to trend down. Thinking about don't buy into that. Oh, we've got rising rates, so that means it's time to abandon fixed income because it all stinks and is headed to zero. That is not the case. So thinking about what your exposure might be in your fixed income portfolio with that interest rate risk versus credit risk. Looking around the world for opportunity, and then as just a reminder, it can sometimes feel like this to me, and I've been doing this for a long time. When we go through market volatility, that this is somehow unusual, or this time is different. It just isn't. The stock market volatility that we're going through right now is part of the investment experience. And I don't expect that to change.
One other question that came in on the volatility of the market: is there specific signs that highlight a better time to buy or sell, or is consistent the best?
Yeah, so I think so consistent is the best. If you want to go to level 2, the best time to buy is going to be when your fear is at its maximum. So back to that. So you think about that slide that we had on the economy and recessions. That was so back in March, when the pandemic, March 2 years ago, when the pandemic started, we went through a 30-something% drop in the stock market. That, in hindsight, would have been a fabulous time to be getting invested. So generally, this is I've seen these stories from any number of kind of legendary investors when they recount their best investment decisions of their professional experience. Universally, they talk about when they made the investment is when it looked the worst. And I remember one interview in particular where the story was being talked about what this investment, which again ended up being one of the very best investments of this person's career. He physically demonstrated the fear by having a shake. He had his hand shaking, as he said, as I went to press the button to make the investment. As convinced as I was, my hand was shaking as I went to hit the enter button. So that speaks to even the pros that are in it all day, every day. Buying at those points of maximum fear is much easier said than done. But that would be level 2 investment decision making.
One other question.
Sure.
Do you advise non-market investments such as to diversify, such as art, gold, etc.?
Yeah, so that's a great question. So you could think about your house as a non-market diversified investment. Gold. Back to that long run performance of gold. I guess I've got two challenges with gold personally. One is the long-term performance of gold is something around the 2% zone. It's quite unattractive. It also seems to me to always be positioned from a place of fear. So you'll never hear somebody say, I think the economy is going to the moon, it's time to back up the truck to gold. It's always positioned from a perspective of we're going to have Spam and bottled water for the rest of our lives and all be eating ramen noodles at every meal. And so you better buy gold. Fundamentally, I just have a problem with that. I'm a unashamed optimist. I'm not interested in investments personally that get positioned from a place of fear. Art. So value takes many forms, and we don't live in spreadsheets, or we shouldn't be living in spreadsheets. We should be out living our lives. And enjoying our lives. I can't speak to the financial benefit of diversifying that art has. I would say if it brings you joy and it's done in a balanced way, I'd say that's a different kind of value that should be present in all of our lives. So I'd come at art from an experiential perspective, not a spreadsheet perspective.
You're an art lover, so what are your thoughts on NFTs as an investment?
NFTs, right? I don't get them. I'm in the crypto world. So yeah, I like walking around our office and physically enjoying the art around the office. I very much enjoy that. Opening up my computer or my phone to look at a JPEG that I bought, which is how I understand NFTs. I don't get it. So I'll stick to the physical art and continue to be an appreciator of it. Yeah, we're covering everything. Okay, this has been fantastic. Love the engagement. Thank you very much. Thank you very much. So we're going to have a recording of this available. If we didn't cover a topic that's important to you, or you didn't feel comfortable talking about it in this context, that's just fine. We are here to be a resource however we need to be. So enjoy your evening, stay warm, and again, thank you for sharing a night with us.